Thank you very much for joining us this evening for the first in our new series of webinars on making the most of your business. We will be running these on a monthly basis, generally around the third Tuesday of the month. Okay, just start off with a little bit about us. We're a bookkeeping and management accounting practice based in Essex. We're currently a team of 4, but we're growing rapidly. We focus very much on our values. We focus on integrity in everything we do. We always act to be the best that we can be. We're supportive of one another and our clients. We like to be proactive. We love to be creative. You might think in accounting, how can that be? But we do find ways in the terms of the services we offer and how we go about things. And most of all, we like to have fun in what we do. We have a very lively office and we've always got our door open for a cup of tea. Okay, the format for today's talk is focused very much around limited companies primarily, though there are aspects that will be applicable to sole traders as well. We're going to start off by having a little bit of a look at the statutory reporting requirements, a bit about demystifying accounting language. I know we can talk what seems like gobbledygook at times. And then we're going to have a look at what makes up the financial statement. So that's your year-end accounts, explaining a bit more what's in them and what they actually mean. Have a look at what the difference is between what the numbers in accounts and what that means in terms of real cash flow. And then some ways in how you can use this information for action planning moving forwards to help you with your business. Okay, in terms of statutory reporting, what everybody's most familiar with probably is your company's house accounts. These have to be produced 9 months after your year end, and there are statutory formats depending on the company size. For example, for micro companies, that's if your turnover is below about 632,000, you'll very often find them as micro accounts. Then once you get up to up to about 10 million, they're classified still as a small company. So that's the sphere that we tend to operate within. Now, from your company's house accounts, what's also submitted is a corporation tax return. That's very similar to a personal tax return, but calculated for your corporation tax. There is a confirmation statement, which has to be filed annually to Companies House, and that is literally just a statement, normally confirming any changes to shareholders, directors, share allocations, and directors' details. You obviously have statutory reporting requirements around payroll. So every time that a payroll is run, a submission has to be made to HMRC using in real time. And similarly with VAT, most people who are registered for VAT, with the threshold being 85,000, that is usually made online. And from April, every company who is registered for VAT will have to make their returns digitally. That's part of the Making Tax Digital. Companies over the VAT threshold for compulsory VAT have been having to do that for a couple of years now, but it's moving across to all companies from April. And then you have the construction industry scheme for construction subcontractors and contractors, and they have to make monthly reports. That's very similar to PAYE. And then there are obviously the director's personal tax return and shareholders' tax returns that have to be made annually by the 31st of January for the previous year to the 5th of April. Now, just considering first the 2 types of expenditure. There is both capital expenditure and operational expenditure. Capital items are what you would find in your balance sheet. These are large, tangible items that will last more than a year. What counts as large will depend on the size of business. For most micro businesses, maybe with a turnover of 100,000, 200,000, I would consider normally anything more than about 100, 150 pounds to be capital. So you're generally talking things like computer equipment, large pieces of tools such as maybe a large drill. So it's things that are going to last a long time. Now, these are recorded on your balance sheet and depreciated, so that means written off over a number of years. The depreciation policies vary by accountant, But for things like computer equipment, it would generally be written off over something like a 3-year period. And the tax benefit of these is claimed via capital allowances. Now, the beauty of capital allowances is that you don't have to claim everything you're able to claim within a year. So if you have a year where maybe you haven't made as much profit, maybe a COVID year, but you've bought capital plant within that year, you don't have to claim it for tax purposes, or you can part claim it within that year. So capital is a nice way of being able to hold back the tax benefit of large items of expenditure from a poor year into a large year. But what you do have to watch is the proportion within which you can claim it back. So, for example, most items go into a pool. So you've got something called an annual investment allowance, which most plant and equipment means that you can claim back, if you wish, up to the full value within the first year of purchase, up to a threshold. It's a very large threshold that most people wouldn't reach. And then after that first year, anything remaining, you write down in a reducing balance percentage. If you don't take use of the annual investment allowance in the first year, then you can only claim it bit by up to the maximum percentage moving forwards, which I think from memory is about 18%. Now, that capital expenditure is very different to your operational expenditure, which is your day-to-day running costs. Now, this is recorded on your profit and loss statement, and the tax benefit has to be fully claimed in the year of expenditure. So capital, there's more flexibility, but operational, there it's kind of, you're fixed very much in the year. Two other terms that you'll often hear in accounting is the difference between accruals and cash basis. And basically, cash basis means that you work from the date of payments being made and received. And accruals basis is the date that is actual on the actual invoices, either sales invoices or purchase invoices. Now, from an accounting point of view, limited company accounts have to be made up on an accruals basis. So, yeah, so everything is done so that any liabilities and debtors or income and expenditure is all reflected within the year it relates. Whereas cash basis, you can use it to sort of, I suppose, for like VAT returns. You can do VAT returns. So if you know that you've issued an invoice under an accruals basis, you would have to take account in the period when the invoice was issued. But on a cash basis, you only take account in the period when you actually get the money. So that can help with cash flow sometimes, particularly with things like VAT. Some other key accounting terms, you have debtors, which are the amounts owed to a company. So these will sit up towards the top of your balance sheet. Creditors, so that's the debts owed, debts owed by the company. So that's people that, for example, banks that you may have taken a loan from. Accruals are goods or services received but not yet invoiced. So an example might be your accounting fees. Speaking from a personal point of view, sorry. Okay, for example, accounting fees, if your accountant doesn't invoice for your accounting until after they've prepared your accounts, they will still include for that accounting fee as an accrual within your accounts. So it acts as a tax deductible expense for that year. Prepayments are goods or services paid for but not yet received. And then you have work in progress, which are adjustments for values of goods or services being made or in delivery. So, for example, for a construction firm, this might be a case of at year end, you might have a project, maybe 50% complete, where you haven't yet invoiced, but you would account for the income relating to that project within your annual accounts by making an estimate as to value of the work completed if you were to invoice it. The other with assets, you have intangible and tangible assets. So tangible are physical things like vehicles, land, property, equipment. So that would be things like tools, computer equipment, a building, if you own a building where your office is based. And then you have intangible, which are things like intellectual property, goodwill associated with a business. Sometimes when business is sold, goodwill is included as part of the sale, and brand value. Down at the bottom of your balance sheet, you have your share capital that will be broken down into your ordinary shares or your different types of shares at the face value. So you might have 100, say for example, as your share capital, you might have 100 £1 shares. But when those are sold and moved between people, they're often sold for more than their value. So a £1 share might be sold to a new shareholder for, say, £50. So the difference between the face value of £1 and the £50 sales value has to be retained within the balance sheet, and it's known as a share premium. So that £49 is your share premium. And then your dividends are your money drawn from your reserves by shareholders. So as a director of a limited company, you will often take your remuneration as a mix of salary and dividends, which under the advice of your accountant. Moving on to your profit and loss statement, which is now sometimes known as your statement of comprehensive income. You have your sales at the top, less your cost of sales. Cost of sales is the cost of directly producing goods or services. So if you're manufacturing something, it would be the design costs associated with that manufacture, the actual production and delivery, but not the cost of the admin assistant running your payroll. So the difference between your sales and cost of sales gives you your gross margin. Then deducting your overheads and general admin expenses. So that's things like directors' general salaries, printing, postage, stationery, accountancy and legal fees, and adding back any other operating income. So that might be things like maybe a bit of bank interest or that sort of thing. Other operating income gives you your operating profit. Then you add your interest receivable, take away your interest payable, and that gives you your profit before tax. Corporation tax at the moment is calculated at 19%, but that's going to be changing shortly. They're changing within the next year or two due to COVID, and that gives you your profit for the year, which is your net profit. These terms of gross margin, operating profit, and profit before tax, etc., are important for some of the ratios that I'll come on to later. The second key statement is your balance sheet or your statement of financial position. This starts with your fixed assets, which are your intangibles, tangibles, and investments. So that's things like your plant and equipment, property, goodwill, brand value, all sit at the top of your balance sheet. You then have your current assets, which are basically everything else that you own. So that could be like the stock that you hold, people who owe you money, the cash you have in the bank, and those are presented within a balance sheet in terms of how easily you can liquefy them. So, for example, you can lay your hands on cash at the bank if you needed to, a lot faster than you could get your hands on money by selling stock. But debtors are more easy to liquidate than stocks. Then in terms of your creditors, so that's your liabilities, are broken down into whether they're less than a year or more than a year. Again, this is all intended to help people understand the state of your company if they're looking at your accounts. You have provisions for liabilities, that gives you your net assets. Now, your net assets then have to match off the total that you have in terms of capital and reserves. So your reserves are things like your share premium or other different amounts you have as capital held within the business. So you've got your retained earnings, profit for the year. And the third statement that I'm going to cover this evening is your statement of cash flows. This isn't produced for all accounts. For example, it's not usually produced for micro companies, but this is looking at the movement in your cash flow from one year to the next. And what this looks to do is to take out some of maybe the accounting adjustments. So things like depreciation that varies very much between companies depending on the policies your accountant applies. And it literally is just, it looks at all the different items that move your cash flow, and you get a net increase in your cash and cash equivalents, and it compares it from the beginning of the year to the end of the year. So again, it's just another measure of the financial health of your company. So what we've talked about so far is very much about accounting. And there's a real difference between what is in a set of accounts and what's in a real cash flow. So accounts are very much a snapshot for a fixed point in time, generally once a year. If you have management accounts, then they will be a snapshot at the point when the management accounts are set, either monthly or quarterly. They're always backwards looking. They're kind of reporting on historical information rather than looking forwards to the future. And they're always adjusted to meet standardized conventions. So, for example, you have your depreciation, you have certain ways that information has to be presented. There isn't an awful lot of flexibility to tailor them to suit the needs of a business owner. For the statutory accounts, management accounts, there's a bit more flexibility, but statutory, there's not much. Now, comparing that against cash flow planning, which is very much a live process, is forwards looking, tends to deal in smaller time segments. So whereas your annual accounts would be based on a year or a month or a quarter for management accounts, for a cash flow, you might be looking forward maybe a 3-month period and looking at it week by week. A 3-month look ahead is a kind of a good measure. They tend to be a lot more complex and detailed than your annual accounts. Annual accounts are really a summary, but with cash flow planning, you might take it down to individual project level or have a spreadsheet set up so that you drill down into the detail. And you can set them up as a tool for what if planning. So you might want to set up your cash flow and say, if we did this project, what would the impact on our cash flow be? Or if we took it out, what would the impact be? And you can get a really good idea of where your business might be kind of in 3 months or 6 months ahead by scenario testing it. Something that is always useful to look at are accounting ratios. Now, these are standard calculations, and if you'd like some help setting these up, please do contact us. We'd be more than happy to help you set up a spreadsheet for your business to look at these and go over them in more detail. I'm not going to go through them, sort of the maths now, but they're just ways of comparing the performance of your business year on year to have a look at kind of how your performance has improved or decreased. And I would say always look at them over a 3 to 4 year period and kind of compare the year on year changes. So your liquidity is all about your more or less your cash position or your ability to generate cash as a business. So things like your quick ratio and your current ratio are looking at kind of what the value of your current assets. So that's things like your cash, your stock, your debtors, people who owe you money, are compared to your current liabilities. So that's your short-term amounts you owe. And you're generally looking for a position, ideally, where your current assets are about twice what your current liabilities are. You can have a look at things such as the efficiency with which you convert stock to sales. So how quickly you turn your stock over, how long it sits in the warehouse. You can look at how quickly customers are on average paying you and how quickly you're paying your suppliers. So obviously, if you'll find that your debtor days or the time taken for customers to pay is increasing year on year, then you've obviously got something that you maybe need to look at in terms of your accounts receivable processes, maybe how often and how aggressively you're chasing customers. Is there a reason that people aren't paying? And similarly, with your time taken to pay suppliers, if you've got an increasing in your creditor days, is that a result of a conscious decision to get better terms with your suppliers? Or is it an indication of cash flow problems within the business where you're maybe not able to pay them as quickly? Something that banks and loan providers would be interested in is your ability to repay debt. And something considered there is your interest cover. And what you're looking there at is your profit before interest and tax are taken into account against the value of the interest that you pay in a year. And again, you're looking for your earnings to be about 1.5 times what your interest paid is. And then the final thing that I would suggest is considered is your financial structure. Now, your gearing ratio is a measure of your debt to equity. So the amount that you owe through different means against what you have in terms of your capital and your reserves. And long-term debt is very often considered as part of your equity because it's there, it's long, it's stable, whereas your short-term debt, things like maybe very short loans or bank overdrafts, aren't quite so secure. So this is your financial structure, your gearing ratio is a measure of how stable your business is and how secure it is. Moving on to action planning. So how can we make use of this information? Well, with things like we can analyse the information in our accounts to look at changes year on year. For example, we can analyse our spend by category. We can look at our profit before tax. Hello? Sorry, we had internet problems there. So moving on to action planning, we have things like spend by category. We can look at profit before tax and net profit year on year. We can look at our split between fixed assets and current assets, between liabilities and profit, how much we have in our capital and reserves and our debt ratios. And this is where the financial ratios really come into play. We can look at areas where your spend is increasing or decreasing. Detailed annual accounts always include a detailed breakdown of spend categories, and they're always useful to look at maybe year on year and just see if there's somewhere where maybe your spend has jumped over a particular year, and then use that information to help you set and track budgets for key headings. We'd always recommend maintaining a live cash flow forecast, using it to test different options and situations. Now, there are either apps for this, things like Float are good, or Excel. Personally, I prefer Excel because I can tailor it much more to the needs of the specific business. But there are apps to help if you're not so maybe strong on Excel or want something a bit simpler. And then you can also use the information and the trends from your accounts to plan for your tax liabilities. We'd always recommend setting up things like savings account for corporation tax, VAT, and personal tax. And that's the end of the presentation. Are there any questions? I'll just make it so that it's live on the Zoom. Okay, so do we have any questions? That's the end of the formal part. If you'd like to put on voice, you're more than welcome, or we can take the questions through the chat. I will, as I say, I've recorded the presentation, so I will circulate a copy. If you have any questions, please pop them in the chat box. Okay, in that case, I will assume that hopefully it's been a useful session for everybody, and thank you very much for attending. I will be placing the recording on our YouTube site. Thank you very much and have a lovely evening.